Good morning and welcome to the Daily Hunt. It's Tuesday, October 7th, 2025, and we've got a fresh batch of market commentary for you to kickstart your day.
Great to be here, Ethan. Well, looking at the data from yesterday, it's a pretty busy morning. We've got a lot of activity, with numerous posts across a good number of different stocks. There are some perennial favorites showing up again, and as always, a few risky plays getting a lot of attention.
Yeah, definitely some exciting names in the mix today, sparking some real investor optimism. The AI-generated insights are highlighting some strong growth narratives.
True, but my KPI analysis also signals a healthy dose of caution for many of these. We're seeing some real fundamental red flags behind all that market buzz. It's a day for selective analysis for sure.
All right, let's dive into some specifics, starting with the big players. Amazon, ticker AMZN, is still holding strong as a buy, just like our AI flagged it last month, showing consistent performance. With that robust 13.3% revenue growth and healthy 10.5% net profit margin, Amazon continues to just deliver. Plus, the chatter about global expansion and those AI deals, that's pure growth potential if you ask me.
And that's exactly what supports the buy classification, Ethan. Its current price is showing a strong recovery from its 52-week low, and while the PE of 33.67 is higher than average, it's reasonable for a tech leader with that kind of revenue growth and profit margin. Our AI has rated AMZN as a buy since late September, and it continues to meet those criteria today.
Moving on to Meta Platforms, ticker Meta. Our AI-generated insights rate this as a buy too, and it's been a consistent buy for us since the start of October. The sentiment is bullish, with users reporting successful options trades. 21.6% revenue growth and an incredible nearly 40% net profit margin. That's just fantastic. They're investing heavily in AI development and global infrastructure. That just screams future upside.
Absolutely, Ethan. Those KPIs for Meta are exceptional. The 39.99% net profit margin and a 40.65% return on equity mean they are incredibly efficient at turning revenue into profit. The $900 price target from analysts, citing AI ad tools, further reinforces a positive outlook. The fundamentals here are rock solid, justifying that consistent buy rating.
Moving on to Alphabet, ticker Google, is another interesting one. It was a buy for us consistently, then briefly a stay away on October 3rd, but our AI-generated insights have upgraded it back to a buy today. Users are talking about significant profits from past trades. With strong 3.8% revenue growth and a 31% net profit margin, this tech giant is clearly still a powerhouse with plenty of room to run.
It's great to see that upgrade to buy, and it's well supported. While the stock is near its 52-week high, those revenue and net profit margins are incredibly robust. That high PE of 26.81 isn't excessive for a company with such innovative strength, especially with all the positive buzz about their AI initiatives. It definitely earns that buy classification.
Shifting gears slightly, let's talk about Microsoft, ticker MSFT. We've rated it as a buy before, specifically on October 3rd. Today, our market commentary nudges it to a cautious buy. The enthusiasm from users is real, talking about it as an incredible growth stock with those outstanding profit margins and strong revenue growth. It's leading in cloud and AI, and analysts are even raising price targets.
While Microsoft's fundamentals are undeniably strong, an 18.1% revenue growth and a fantastic 36.1% net profit margin, the current PE of 38.75 and the stock trading near its 52-week high suggest that a lot of future growth is already priced in. It's still a high-quality company, but for new money, accumulating on dips might be a more prudent approach than jumping in at current elevated levels, hence the cautious buy today.
Okay, NVIDIA, ticker NVDA, had quite a ride in our ratings. From a stay away in late September, it moved to a cautious buy, then a buy, and then back to stay away yesterday. Today, our AI-generated insights landed firmly in cautious buy territory. The market commentary is buzzing about 55.6% revenue growth, a 52.4% net profit margin, and analysts are predicting huge upside potential, talking about AI vibes driving this stock. That's just incredible performance.
And Ethan, those are indeed impressive growth and profitability numbers. But, and this is a big but, its PE ratio is still 52.86 and it's trading very closely to its 52-week high. While the fundamentals are strong, a cautious buy is warranted because much of that positive outlook might already be factored into the price. Plus, that billion-dollar chip shipment to UAE being put on hold and AMD challenging an AI suggests the competitive landscape isn't getting any easier, so proceed with a bit of extra vigilance.
All right, let's get into some of the more spirited debates from yesterday's data, starting with AST SpaceMobile, ticker ASTS. This one has consistently been a speculative gamble for us, which we classify as stay away, since October 3rd. But man, the community sentiment is incredibly bullish. Users are calling it a multi-bagger, celebrating huge gains, and excited about successful direct-to-sell tests and partnerships. It's a high-growth company with potential advantages over competitors.
And this is where the cold, hard KPIs clash with the enthusiasm, Ethan. Despite the buzz and positive news, ASTS is unprofitable with negative earnings per share. Its price-to-book ratio is an eye-watering 21.05, and it has an incredibly high beta of 3.06, meaning it's extremely volatile. Betting on it is truly a speculative analysis. Our consistent stay-away rating reflects the extreme risk due to its deep unprofitability and sky-high valuation based purely on future hopes.
Okay, let's quickly cover some other names that our AI flagged as stay away today.
Right. Opendoor Technologies, ticker OPEN, continues to be a stay away and has been since late September. It's got negative profit margins, huge debt, and a high beta. Frankly, many users are calling it a meme stock. Tesla, ticker TSL, also a consistent stay away since September 25th. That astronomical PE of nearly 270 combined with negative revenue growth makes it a fundamental stay away despite any new model teasers.
Oof, and then Advanced Micro Devices, ticker AMD. This one is always a hot topic, with massive community excitement around its OpenAI deal and big gains, but it's been a consistent stay away for us since late September.
And for good reason, Ethan. That PE of 121.98, coupled with a negative operating margin, means its core business isn't profitable right now. Plus, its high debt-to-equity ratio adds significant risk. The market is pricing in immense future growth, but the current financials just don't support it for a solid investment. Quickly touching on the rest of our stay-away list, Rocket Companies, RKT, new to our list, has negative EPS and an extremely high debt-to-equity ratio. Poet Technologies, ticker Poet, despite the AI hype, is deeply unprofitable with massive debt. AppLovin, APP, another newcomer, has an extremely high PE and PB, along with a significant debt-to-equity ratio and an SEC investigation looming. Bitfarms, BITF, remains unprofitable with high debt and high volatility. Rocket Lab, RKLB, is unprofitable with an extreme price-to-book ratio. Next NRG, NXXT, also new, shows impressive revenue growth but is deeply unprofitable with a negative book value. And Reddit, RDDT, still has that sky-high PE and PB, signaling extreme valuation and volatility. All remain speculative and should be approached with extreme caution.
So, to sum up today's market commentary, here are some candidates to take a deeper look at. Investigate as buy. Amazon.com, Inc., AMZen. Meta Platforms, Inc., Meta. Alphabet, Inc., Goog. Investigate as cautious buy. Microsoft Corporation, MSFT. NVIDIA Corporation, NVDA. And now for today's speculative gamble. This is the one where the community is buzzing with optimism, despite our AI-generated insights flagging it as a stay away. Investigate as speculative gamble. AST SpaceMobile, Inc., ASTS.
A quick word of caution, as always, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and summarizes publicly available sources to help you focus your own research.
That's right. The data we discuss could be outdated, and it's crucial that you conduct your own thorough research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses.
The market is a wild place and knowledge is your best asset. Thanks for tuning in to The Daily Hunt. We'll be back tomorrow with more market commentary.
See you then.